Corporate governance. Okay, I know it might sound a little dry, but trust me, it's the hidden operating system of every successful company out there. It's the framework that steers the ship, manages the engine, and ultimately decides whether a business creates real, lasting value. So today, we're going to pull back the curtain and go way beyond the rulebook to see how it really works.
Okay, so where do we even start with all this? Well, it really comes down to three big questions. These aren't just theory either. These are the practical challenges that boards and investors are wrestling with every single day.
And to even begin to answer those questions, you have to realize something crucial. There is no single one-size-fits-all playbook. So first up, let's take a quick trip around the world to see how different places try to keep their biggest companies on the straight and narrow.
Right away, you can see just how different the approaches are. You've got the UK with its super flexible comply or explain model. And then you jump over to Germany, and they have this really structured, rigid two-tier board system. Japan, they're zeroed in on board independence. And then you have a place like Singapore, which is already looking to the future, building things like tech risk right into its code. But here's the interesting part. Even with all these different flavors, you start to see a common core taking shape. No matter where you look in the world, it really all boils down to these three pillars: having strong oversight, being transparent, and getting smart about managing risk. So this variety we're seeing, it leads us right into the central debate, the big argument that's been at the heart of corporate governance for decades. How exactly do you make all that happen? How do you get that transparency and oversight? And you can really boil that whole debate down to one simple question. Is it better to have a rigid rulebook with strict, non-negotiable requirements that everyone has to follow, or is a flexible compass the way to go, something that offers guiding principles that companies can use to find their own way? So on one side, you've got the rulebook approach. A perfect example is the Sarbanes-Oxley Act in the US. It's prescriptive, it's mandatory, and it is crystal clear. That makes it pretty simple to enforce. And then on the other side, you have the compass. That's the UK's code in a nutshell. It's all about the final outcome, giving companies the flexibility to do what works for them, as long as they can clearly explain why. So, rulebook or compass? Which one is winning? Well, here's the twist. In the real world, it's neither. What we're actually seeing is this powerful and really practical hybrid model emerge, one that gets the best of both worlds. So how does this hybrid thing actually work in practice? Well, you can think of it in a few layers. At the bottom, you have a solid foundation of hard, non-negotiable rules, especially for things like financial integrity. On top of that, you have a layer of flexibility, principles that guide things like strategy and culture. But here's the secret sauce. That third layer, active, engaged investors who pretty much act as the ultimate referees. And that is really the new global standard. See, it's not about picking sides anymore. It's about using both. You get the certainty that comes with hard rules, but you also get the smart adaptability of principles. It's about building a system that's strong, but also smart enough for the crazy, complex world we live in. Okay, so that's the big idea. But what does this look like when the rubber meets the road? Well, the world's best companies, they're not just following this hybrid model. They're actually using it to get a real edge on the competition. The real leaders, they don't just follow the code. They're the ones redefining it. And we see them doing this in three really important ways. First, they're always looking over the horizon at new risks like AI or climate change. Second, they're not just reporting numbers, they're explaining the why behind their decisions. And third, they treat their investors like real partners, not just critics. I mean, take a look at Toyota or the big Singaporean bank DBS. For them, governance isn't some boring legal thing you have to do. No way. It's woven right into the fabric of their business. It shapes their long-term strategy. It guides their sustainability goals. And you bet for a bank like DBS, it's absolutely critical for managing technology and cyber risks. It helps them see problems coming a mile away. And then there's this move toward what you could almost call radical transparency. You look at companies like HSBC or Siemens, and they're going way beyond the minimum requirements. They're publishing detailed reports on their own board's performance and showing exactly how they listen to shareholders. That's not just for show. That builds incredible investor trust, and that is a massive asset. And Apple is a perfect example of this. They don't just ask, what's the legal minimum for an independent director? They're asking, what do our investors expect from us? What skills do they want to see on our board? They get that the market often has a higher bar than the law, and they aim for that higher bar every time. So when you put all this together, you see this massive shift in thinking.
It's a total reframe of what governance even is. The best companies have stopped seeing it as a compliance burden to be endured and started treating it like a strategic muscle. It's a core capability that gives them the strength to execute their plans better and build trust that you just can't buy.
And honestly, if you take one thing away from all of this, let it be that. For any company that truly wants to lead, the era of treating governance as a simple box-ticking exercise is well and truly over. It's all about building that muscle.
So I want to leave you with a question to think about. For any organization you're connected to, as an employee, an investor, whatever, ask yourself this: is its governance just a weight holding it back, or is it the very thing giving it a competitive edge?